It's not about picking stocks. It's about picking the right portfolio. To be very clear, modern day Wall Street is built on the addiction to easy money. That is the drug, okay? So anytime there's a market event, bear market, we should be old enough to remember the ones that were born out of recessions, 2001 rate cuts, 2008 rate cuts, 2022, don't forget, when the stock market crashed, rate cuts. Again, betting, wanting, needing rate cuts. But just because they wanted it, don't forget that after that decline into June and July of 2022, rate cuts were priced into the federal funds futures curve. So again, that's just the street's bet almost. And by the way, you can bully that bet. You can put a bet on that forces the Fed, or you think forces their hand, but that has not worked going back to 2022. People have been betting on rate cuts since 2022 have been dead, very technical term, fucking wrong, okay? So there you go. Now they're trying to price in a rate cut by the month of March, okay? The ECB, by the way, now they have competition on that. The ECB is pricing in their first rate cut, or market expectations are pricing in rate cuts for both, one in March for the Fed and the first one for the ECB in April. So as soon as that happens, now the euro goes down, the dollar goes back up, and spy monkeys who don't know the correlation are probably still buying the S&P futures this morning. But again, and again, to channel my inner Herb Brooks, one of the greatest movies, Miracle. Yeah, this can not happen, may not happen, probably won't happen. And by the way, once we get next week's jobs report, if it's a quad 2 monthly number, i.e. it accelerates from the last jobs report, which couldn't have been worse, bond yields could go back up. They're already going back up this morning, by the way. And they're going up from the low end of the range. You can see that on the 2-year, the 10-year, and both the 2-year and the 10-year, which I put in the early look, the risk ranges, and they're also in your risk range product, but I also added where is the long-term tail risk of support for those things, and it's below the last price. So again, to me, and I'll say it as many ways as I can, the Federal Reserve is unlikely to cut interest rates anytime soon unless we aren't bearish enough on the recession, and it's way worse than even Hedgeye thinks. And again, recession is not a catalyst to buy stocks. We have plenty of stocks that we're long, by the way, as you know, both analyst picks and sector exposures. We have 26 asset allocations. There are plenty of things that I need to risk manage now that everybody feels like a winner after November of 2023, just like they did after the November of 2007 and November of 2021. Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there. Subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content.